Hey guys, what's going on? It is Kevin here and welcome back to the channel. In today's video, we're going to be reacting to the Iced Coffee Hour with their guest Humphrey Yang. Definitely some interesting takes in this clip that I just had to react to. So let's not waste any more time and jump into this reaction.
We were talking about the S&P 1 yesterday,
Yeah.
which I thought was interesting too. You want to tell people about that?
Yeah,
We
so
and
the
then we'll get Graham's.
the S&P one, and that's another argument for like Nvidia or like any of the other like top, 3 companies or whatever. The S&P one, if you look at the way it's performed over the past 20 years, it is obliterated.
What
The
is the
S&P
S&P 1
500.
again?
The S&P one is when you buy the number one largest market cap company, and then as soon as a different company takes over and becomes the largest in market cap, you immediately sell and buy that company.
Yeah, but you're getting a tax consequence in that, so you're constantly trimming.
What did we just talk about? We just
I'm just saying,
spoke about
constantly selling.
Dude, this
And
doesn't happen every 3 months. Like, the number one market cap company changes a lot of times they'll ride out for a few years. So you have long-term capital gains. But yeah, if you rode out the S&P 1 for the past 20 years, the returns are like, I don't even know. I will put up a example right here, but like
Sure.
3 or 4x the SP
Does
500.
is that before or after tax?
Probably before tax.
I'm
What do
just
you-
saying, when you constantly trim your position,
Yeah.
depending on your tax bracket, 20 to 23.5% or whatever it is, you're constantly trimming that down and then reinvesting. You have to outperform.
Of
By
course,
that
plus 30.
amount.
Yeah, I agree with you, but you literally said 10 minutes ago that every single time you've made a decision based off of taxes, it is not healthy.
And you're giving me another hypothetical scenario.
It's not
where
a
it's like-
hypothetical scenario. Like, you can look at the data. I don't know.
Okay, we'll look at the data.
The question is, how well does it actually perform? Because their chart there was very illustrative and not at all a thorough back test. So what I've done here is I've actually back tested it, and it's pretty interesting to say the least. So the data that I've found here, and I'll throw some charts on screen myself, is over the past 20 years, which is what he said, the S&P 500 has underperformed this strategy of holding it for the top stock, but it really depends on how the rules are set up, and there's more to it than that. So he said you should buy and sell the stock every time it changes. That can be very frequently when the top companies are very similar in market cap. And the more you trade, the worse the results are. So this chart here actually shows, the S&P 1, annually you check and change versus monthly and then daily and then the actual S&P 500 total return. So the really interesting part here is that while it is true that over the last 20 years, if you change on an annual basis, so not daily, not monthly, but on an annual basis, you're buying and getting that new number one spot, that is the best performing case out of the three methodologies that you could apply here. But of course, after tax, it takes a hit. And the really big thing here is if you back it up, say to 40-year period, that performance is completely opposite. So just holding the S&P 500, the boring old index, is going to vastly outperform this strategy, even on a best case scenario over the last 40 years. And that also begs the question, what about on an on a risk adjusted basis? Even for the last 20 years, when you account for risk, it really is basically a wash. And that is a very important thing to understand because a lot of people like to act like cowboys when it comes to their investment portfolios, but depending on which timeline you're working on, those drawdowns are so significant that I highly doubt anybody would actually hold on to them. For example, in the longer time horizon, the S&P 1 back tested as having an 83% drawdown, and it took nearly 17 years to recover. Of course, guys, I doubt that the vast majority of people are going to hold that long and be able to handle an 83% drawdown all in one stock. And that's the beauty of diversification, is that you're diversifying to get you through those harder periods. And in the long term, it actually did outperform anyways. So I will include the data on this in the description below so you guys can check it out yourself.
What is the perfect portfolio for someone watching this right now?
Moderately conservative. I'd probably say 90% stocks, 10% other. Other could be, if they're more conservative, fixed income. Other could be, if they're more aggressive, speculative assets. But yeah, I think if you're young and you're making money, 90 to 100% equities is probably fine.
So when we usually use the term moderately conservative, you generally aren't going to say 90% stocks and like 10% bonds or whatnot. That's pretty aggressive in the bigger picture. Sure, you could throw in things like cryptocurrencies and all this stuff, but if we're talking on a realistic basis, when you say 100 or 90% stocks, that is pretty aggressive. Somebody that's, 80% in like bonds or like T-bills and 20% stocks, that's very conservative.
And what do you mean equities? Like, how do you determine which stocks you would want to buy?
Most of the time, just S&P 500 is good enough.
Is that what you do personally?
That is not what I do personally.
So what do you do personally?
Personally, I've been buying more individual stocks.
And why do you do that instead of buying the S&P?
I think my appetite for risk has gone up over time as I've been making financial content, and I'm always paying attention to the markets. I'm investing in big companies that I know and love, and I know intimate detail, or not intimate, but I know them intimately. So my portfolio has been getting more weighted towards individual stocks, but I think, I was on the Money Guy show maybe like 6 months ago. I think I need to diversify back into the S&P 500.
Why would you say that? Have you done well with individual stocks?
I have done well with individual stocks, but I do think that the entire market has done really well with individual stocks, and I just really want to make sure that if I have the amount that I have so far, that I protect that capital. And so I should really take my own medicine there. So I think I've learned a lot on this podcast, which is I should probably spend a little bit more, right, in my personal life, and I should probably take my own medicine and diversify back. But the tax hit on the individual stock is tough.
Yeah, that's pretty good advice. You don't really need to run up the scoreboard too high. And the reality is that if he's done well in individual stocks, that's great. But like he mentioned, it's a rising tide out there for a while. So it's good to protect what you've earned and, maybe divest out of that or diversify into something even still pretty aggressive, which is, 90 or 100% in the S&P 500 in the bigger picture compared to like single stocks. And for him, that could be a good investment decision. It just depends on his specific scenario.
Do you think that people should consider tax consequences when investing in stocks?
Yes.
How long are they investing for?
Let's say they're investing for retirement and they're in their 20s or 30s.
Then probably not. Not as
So
much,
if they have
especially if
gains,
it's in a retirement account. Yeah,
Let's
probably
say
not.
it's not, though. It's a taxable account. You see, you made a whole bunch of money, but you're like, oh man, if I sell it right now, I'm going to have to pay all this tax.
Yeah, I mean, I don't know. That's a tough balance because what is their situation going to look like when they're 65? I don't know. Is their tax bracket going to be really high for long-term capital gains? Um, are they going to be able to weather that tax bill depending on their other assets? I'm not sure. So
I've
that maybe is not a good question for me because I'm not sure.
Yeah, whether or not you should have the tax consequences, being the forefront of your investment decision is obviously going to come down to your specific scenario and what you're trying to accomplish. But I would be wary of, the only thing you're thinking about is taxes going into an investment. That shouldn't be the number one thing, but it should be a pretty high up on the list is understanding the tax consequences and, thinking about that long-term tax drag if there is going to be one. And like you mentioned, if you're in like an IRA or something, that's different versus like a taxable brokerage account. So again, it comes down to what you're actually working with, but it should be something you consider, 100% be something you consider. More tax efficient investments are gonna, earn you a higher return compared to non-tax efficient investments of the same kind. So just something to think about.
I've made more mistakes avoiding the tax than I have riding it out. Like there's so many
Right.
positions where I was up a ton and I said, oh man, I don't want to sell it because I'm going to have to pay the tax. And then it just drops. Like I lose
Yeah,
all of the
but on
profit.
those
And I'm like,
positions, would you have held for 40 years, or are these like that you're up a lot on, or are
some
you
of
just
them, like,
selling to
I'll give you
sell?
an example.
Yeah.
Ethereum, I bought in at the very bottom of like 2020 something. Uh, and I was up like 100 and something percent. And I figured instead of selling it, I'm just going to let it ride.
Okay.
And now I'm basically break even on that. Or no, I'm down a little bit, I believe.
So you would have preferred to sell it, take the tax
Yeah.
hit, but at least have the gain.
Yes.
But
And what's
you would have not known if it could have gone up to 10K,
yeah,
right?
that's true.
Yeah.
The other funny thing is, of course, the one time I do start to take profits, it was on Bloom Energy. And I started selling at like, I sold a little chunk at 250, a little chunk at like 275, a little chunk at like 285, and now it's past 300. And of
Yeah.
course, it's the one stock where I'm like, I'm going to trim some of this. That's the one that just keeps going up higher.
I feel like you're measuring yourself up against the perfect investment, though. Like, you still, what
Which is, like,
percent
perfect
return did
timing.
you get in Bloom, and over how long of a time
Oh yeah,
period was it?
hundreds of percent. But I'm paying taxes as though it's like ordinary income, basically,
Mhm.
short-term gains.
I would say that's like the only real distinction that I would make. Obviously, it's extremely nuanced and it's a case by case
Sure,
basis.
yeah.
But if you can hold it out, so you're not taxed at short term capital gains and you're taxed
Of course.
at long term, then that's like the biggest thing. And then past long term, I don't think that tax consequences should make any decision
Like,
for
it
you.
shouldn't guide your investment decisions,
Correct.
and I agree too.
Yeah.
Yeah, it completely depends on an individual basis. I definitely think you should consider the tax consequences, even if you're looking at long-term capital gains and how that fits into the broader picture. If you're someone in your 20s and 30s, that's a lot different than somebody, going into retirement and how they're structuring their investments, right? So I agree that it's on a, per person individual basis. But again, taxes are very important to understand. And if you don't understand the tax side of your investments, then you're probably going to get killed out there.
What do you think are the best investments to get rich?
The best investments to get rich? I mean, that's a loaded question.
What do you think?
It's tough because, like, concentration does really get you rich fast if you concentrate on the right thing, but it can also ruin you fast. So, um, do you want risk of ruin? Then
Yeah,
if you
you
want risk
tell
of
us whatever that means
dude,
to
if
you.
you want risk of ruin, then yeah, you can concentrate in any, individual stock that you want. And if it 10x's, then it 10x's. But if you want the disciplined approach where you're going to get rich slow, then index funds.
What do you think about the market being at an all-time high right now? Do you think people
It's a little
should
frothy. Yeah.
do you think people should invest differently with the market hitting an all-time high?
No, dollar cost average. DCA and chill.
Always and forever dollar cost
Dollar
average.
cost average. Time in the market beats time in the
What do
market.
you say to
I
the
love
people
that.
who feel like they should sell a little bit right now and maybe take like half off the table with the market the way it is right now?
I would ask them if it's out of a need, like a psychological need, or if it's out of like a portfolio need, or do they need the money, or they're just worried that it's too high.
Yeah.
I would reevaluate your time horizon.
Yeah, I definitely, I mean, it depends on the circumstances, but I would not be adjusting, my portfolio based off psychological needs if the market's high. We know that the market, when it's making new all-time highs, it usually keeps on making new all-time highs. And new all-time highs are nothing to be worried about because that's usually not a bad thing. Psychologically, people don't like all-time highs, which is the ironic part. It's good for their portfolio, but I guess not psychologically because they think that the market has to drop, like there's gravity being applied to the chart that they're looking at. When it's it's the opposite. A little quote that I like to say is, or I've heard of, is the market can remain irrational longer than you can remain solvent. So basically that means the market might be disconnected, it might do weird stuff, the ratios might be out of whack, but I guarantee you can do it that longer than you can do betting against the market. And that's the biggest takeaway I would take away from that little short part there is just don't try to bet against the market, try to outsmart it. It will not work out in the long run.
Like, if you're going to be investing for 30 years, like, should you be selling half right now? Because in 30 years, it's probably going to be higher than it is today. So, no.
Do you feel any desire to sell?
Oh yeah, I do, but I fight it. I'm not going to sell, but yeah, definitely.
Interesting.
Yeah, I feel it. Like I see the market right now, and it makes no sense to me whatsoever.
Yeah, things are getting disconnected
They
from their
are.
fundamentals. Of course.
And the same thing happened. I remember in 2021 when people were throwing like, "Oh, I'm going to add Bitcoin to this," and then it goes up in price. People are doing the same thing with AI. They just say, "Oh, we have this new AI division." It's like,
I think it really depends on the type of investor you are, right? Like, if you're investing for really long-term stuff, retirement account, passively, you're not even looking at it. But if for someone like you or someone that's very active in the market, maybe you could trim a little. Sure.
I wouldn't. I know
But you
myself.
could. But you could if you wanted to. If that's what you really believe, which is like we're at an
Yeah, but
all-time
I
high.
also know that I don't know enough to be able to beat the market.
Got it. That's good.
Yeah, I really like what Graham is saying there. He has this, this little voice in the back of his head that's saying, hey, maybe you should, sell some of your stocks. And, the market's pretty high right now, but he's overriding that with his, I think his experience in the market is what's telling him not to do that. I think Graham, from what I've seen across his videos, is that, he's tried doing that a few times where he's maybe tried to get out of the market when he thought it was high or try to time the market. And he looks back and says, dang, if I would have just stayed in it, I would have just done better. So I understand what Humphrey there is saying, but I think Graham has the right instinct there.
And that every time I think, okay, this is it, it's the peak, it's going to double from there.
Well, there you have it. And if you are new around here, please go ahead and subscribe to the channel. Any likes and comments are greatly appreciated as well. And I do want to give, a shout out, of course, here to the Iced Coffee Hour, because I'm using their clip and reacting to their commentary. And again, they're doing this off the top of their heads in a 2-hour long podcast. So I don't want to be too hard on these guys, but I just want to make sure that the record is clear on that specific strategy. So again, thank you guys so much for watching, and I'll catch you in the next video.